Hello, everyone. My name is Skip Sims. I'm Senior Vice President of Ann Arbor Spark, which is a public-private nonprofit economic development organization serving the greater Ann Arbor region. And I'm also the managing member of the Michigan Angel Fund and a member of the Michigan Angel community. Our presentation today is about angel investing and specifically angel investing in the state of Michigan. So let me start by sharing my screen and we'll get started here with the presentation on angels. And so the one thing we want to mention is one of the things we're doing through Spark, and thanks in part to a grant from the Ralph C. Wilson Jr. Foundation, is actually recruiting and educating individuals, households, high net worth households who are interested in startups, in supporting startups, and considering or asking them to at least consider investing in startups as an asset class, including that in their diverse portfolio of investments, right alongside real estate, commodities, the stock market, et cetera. Investing in startups as an angel is an asset class, and we want people to consider that, doing that. So our agenda today is to talk about the entrepreneurial capital ecosystem, explain at a high level, nationally and locally, what that consists of, an introduction to becoming an angel, and then the angel investing process, due diligence, term sheets, valuation, et cetera, things that you need to learn, some basics, we'll cover all that, and then post-funding engagement with companies. And what's really important is that this presentation applies to entrepreneurs too. So entrepreneurs, in learning who angels are, what their motivation is, what their expectations are, entrepreneurs should be very aware of that as you're trying to raise capital from them. So the presentation is designed for two audiences, people who are new to angel investing or considering angel investing, and entrepreneurs who seek angel investment. So let's start with the whole ecosystem. What is the entrepreneurial capital ecosystem? Well, it's mostly angel investors. Most startup companies don't really fit the venture capital model and are not going to receive any venture capital investment. They're going to receive capital from individuals, and that's the reason the angel community is so important to the entire ecosystem, and as I'll point out soon, to our entire economy. So a growing economy includes a vibrant entrepreneurial ecosystem. Entrepreneurs provide diversification. They come up with all the next new things that improve our quality of life, et cetera. Angel investors are a significant component of the economy because they provide the fuel. Studies show that small, young companies create a majority of US jobs. Go to the Kauffman Foundation, and there are decades of reports, studies, research that find that 90% of net new jobs in our country are created by startups that are less than 5 years old. These companies match the profile of startups funded by angel investors. Successful entrepreneurs create significant net worth as well. Net worth that allows one, you pay taxes on your capital gains for the investors, but also in the early stages, they're creating jobs, they pay payroll taxes, they fund various other elements of the economy, and by creating net worth for themselves, the entrepreneur is also then able to do it again, create another company and build it up, and or become angel investors themselves to keep the cycle going. Many of you have seen this chart before, but for those of you that haven't, let's start with the life cycle of a new company. First of all, it starts with an idea. I've got an idea. I think that here's a great need in the marketplace. And so here's my idea to meet that need. And so the entrepreneur begins down the path and bootstraps, meaning they fund the idea development initially, at least themselves. They'll partner up with somebody to help them create a minimum viable product. In the innovation stage, in the pre-seed stage, as is identified on this particular chart, they may go to an accelerator, they may go to an incubator to get some additional assistance. They may use crowdfunding to actually sell their prototypes and their beta products to the to citizens. There are all kinds of government sources. And by the way, Michigan, I think, excels among all states in the country in terms of providing entrepreneurial resources. But we're not going to get into that. We'll leave that to others to talk about. And then, of course, the initial capital that is beyond a person's own savings account are friends and family. So you go to your friends, you go to your aunts and uncles and parents and siblings and whomever else in order to raise that first many thousands of dollars to actually get your product created. And in the meantime, all you're doing is what we call burning money. You are spending all this money without any income. And so that's the bottom black line showing a decline relative to the spending. Then when you get to the seed and startup, then you've got a product, you've got probably someone using it, and hopefully someone beginning to pay you for it. And this is where angels start to get interested now and willing to consider writing a check. The company at the bottom starts actually generating some revenue and maybe starts then the upward curve of success. In the introduction stage, the early stage, that's where venture capital may or may not be interested. More angels may be more interested in writing more checks, and you're actually now growing the business. You're actually selling the product to a lot of customers, et cetera, and growing the business hopefully to profitability, which is that break-even line where we have venture capital, and then you're going into the later stages and you're actually profitable. So that's the life. In terms of a time frame, that can take anywhere from a couple of years to 10 years. This is not done overnight. So angels are critical in that they actually are serious investors. They actually invest $25 billion a year into these startup companies. Who are these angels? They're wealthy individuals or households investing personal funds, and usually on a part-time basis. This is not a full-time job for an angel investor, very much part-time. A majority of angels were or are successful entrepreneurs themselves. And as I mentioned earlier, when they create their wealth by creating successful companies, then they're eager to give back. And one way of doing that is to supporting another entrepreneur in their startup. They often invest as members of a group. We'll talk more about that in a little bit. Typical investment, $25,000 in a round of about $1 million, but then, that's kind of, like I said, typical. It could be as little as $5,000. It could be in a round of 250,000, or it could be, $100,000 into a company that's raising $1 million, $2 million, $3 million. The investment is in seed and startup stages for the most part, or even a little bit later. Follow-on investment is critical. So one thing we want to explain to all angel investors is it's not just one check, not likely to be just one check. As the company grows, they will need additional fuel for the growth, and so be prepared to write a subsequent check with other investors to fuel that growth. And follow-on investment is in fact critical, and so plan accordingly. And strong interest in an exit strategy and total investment to get to an exit is what the angel investor is looking for. What are the motivations? Well, first of all, it should be returns. But a lot of people, some angel investors are doing it for the good of the cause, to diversify the economy, to help the economy grow. If they don't get all their capital back, They're not all that disappointed because of the benefits that occur during the years that the company is actually growing and the benefits it provides. But most angels are, in fact, looking for a return. And they are doing it to support the community, the state, to grow and diversify the economy. And of course, they are doing it to create jobs, which drives our economy. Angels invest time as well as money in potential high growth companies. They need to find the deals. We'll talk more about that process in a little bit. Performing due diligence on deals is they have to do, they should do. Negotiating the deal. Some angels are good negotiators, some leave it to others. And mentoring and serving on boards. A lot of investors are motivated by providing that level of continued engagement. And that's why they do it. Investors in 2020, the Center for Venture Research at the University of New Hampshire does a nationwide gathering of data as best they can. And they, in 2020, identified or had 64,500 almost entrepreneurial ventures identified that received angel funding from about 335,000 active angel investors. Each of those investments created on average about 4 jobs in those companies. The average angel deal size was about $400,000 for about 10% of the equity. That makes a post-money valuation of a little over $4 million. The yield rate is interesting, and entrepreneurs, listen up. That's the percentage of investment opportunities that an angel looks at and then actually funds. So that number is, in this particular research report, was 31%, meaning that 59% do not get funded. 69% do not get funded. So you're competing with other entrepreneurs who are asking that individual to support them and write them a check and invest in them. But they're only agreeing to do that with about 1/3 of the companies that they see. Women angels represented about 30% of the angel population, but 33% of the entrepreneurs asking and finding, they're the founders, CEOs of companies. Minorities, on the other hand, represent only 5.5% of angel investors. We need to work on that. Minority-owned ventures account, though, for only, same situation, only 5% of deals coming to angels are by minorities. And we need to work on that as well. And the sectors that are being invested in, healthcare in 2020 by far was 30%. One reason healthcare also is usually the largest sector in terms of receiving dollars is because healthcare requires more dollars for those kinds of startups to grow and be profitable. Software, 23%, and that's been declining over the years simply because software requires less capital than it used to. Energy, 9%, finance, 9%, fintech companies, retail, 8% of angels investing in retail, and 6% in biotech. Biotech may be in part too because it is so capital intensive. And angels don't write that large of a check to continue. And biotech also takes a much longer life cycle usually to get to an exit. So let's talk about the state of Michigan. We started doing at Ann Arbor Spark about 3-4 years ago, collecting this data for the state of Michigan. And so in 2020, it was our 4th report. And here's basically what we found in summary. Angels in Michigan invested nearly $50 million in 102 Michigan companies. Now that 250 million you see there, total dollars invested, that is total investment. So that includes beyond angels, obviously, and venture capital that has gone into, but not all 102 companies, in a much smaller number of companies. But the VCs will write, $1 million, $5 million, $10 million checks in foundations and corporate venture firms. write big checks. So that's how you get that 250. The amount of money that was invested, and we'll show you that in a moment, declined in 2020. The typical Michigan angel put in about $30,000 per company. And we identified over 1,000 angels in the state making these investments. And the good news, 22 of the 102 companies funded were women, and 25%, a big number, minority companies were funded in 2020, and nearly 1,000 jobs at these 102 companies. And here's how it kind of stacks up across the state. We divided the state into 4 regions. You've got the Detroit area, the Ann Arbor area, West Michigan, which includes Kalamazoo, Grand Rapids, Holland, all that geography, and then the rest of the state. Of course, it was down. You know, that's pandemic year. That was shock year. Whereas Q2, we were all in shock trying to figure out what's going to happen next. But then things loosened up. Investing activity resumed in the third quarter, and that was a very positive thing. 31 deals got done in Detroit, 42 in Ann Arbor, 14 in West Michigan, 15 deals around the rest of the state, a lot of that Traverse City. And the investment dollars, for the most part, were up in Detroit. They were up in Ann Arbor, and they were down a little bit, but not insignificant, 34 million in West Michigan. So here's the trend we have found over 4 years of doing this. 2019 was an awesome year. Over 1,300 angels invested over $73 million. It dropped off, which we expected in 2020. Still over 1,000 angel investors wrote checks, nearly $50 million. Now on the right-hand side, what was encouraging was the number of companies finding that funding did not drop nearly as much as we thought it would. 106 companies got investment in 19, and 102 received investment in 2020. But the size of the investments were down quite a bit. And so from the average angel from 50,000 to 30,000. And we fully anticipate, and this is all anecdotal, in 2021, when we do our 5th report, numbers could very easily get back to the 2019 levels. So returns to angel investors. This is important in that they need to be, you're looking for that investment. What kind of investment are you looking for? Well, you're looking for a 2.5x return of your capital. And you'd like to see that done in about 4.5 years. That comes to an IRR of 22%, meaning from the stock market, you may get 5%, 10%, something like that. From your angel investment, you should expect a 22% annual return. And of course, there are a variety of ways that we'll explain what you need to do, what your strategy needs to do to be expect to have achieved that level. Excuse me. The mitigation of risk is this. First of all, if angel investors need to be diversified, you need to be creating your own personal portfolio of startup early stage company investments. And diversification is the key in a variety of ways. First of all, the number of companies you invest in, but also being in multiple business verticals. Don't make it all healthcare, don't make it all software. Diversification by stage. Nothing wrong with having a pre-revenue company in your portfolio, but then also have a later stage company in that portfolio as well, and companies that are in the growth stage as well as still in the startup. So be diverse in that way as well. So you can look up online what Monte Carlo simulation is, how that is calculated. But based on that kind of a simulation, a researcher, Wilt Bank, a professor, did this and basically determined that if you only make 6 investments, the odds are 50-50 that you're going to get all of your capital back from those 6 investments. But if you invest in 12, you increase your odds of getting 2.6 times your money back by up to 75%. And if you invest in 24 companies, there's a 90% probability that for the portfolio, you're going to get 2.6 times your capital back. That should be your expectation and how you do it. So angel groups and the funding process. Let's talk about groups. To me, groups just make sense, particularly for people just getting into this asset class and becoming angel investors for the first time. For all of these reasons that I'm going to go through. First of all, deal flow. You don't have to figure out how you're going to do this on your own, which can be time consuming. Let the group rather, bring deals to you and do that work for you. There's no obligation when a company comes to the group that you have to invest, but deal flow is a very important aspect of this whole thing, obviously. Best practices, well, groups, first of all, screen deals for whether or not they meet the group's criteria. Groups help with the due diligence and make the due diligence process a lot quicker and easier on everybody. And groups, you can rely on the more mature angel investors in the groups to help you with the deal terms and negotiating those terms. Expertise managing the deal flow, you've usually got one or two or even maybe a small committee or board of your angel group that is managing the deal flow for you. Due diligence, know-how, and business segment expertise. The groups always have a handful of people that love doing this and do put in a lot of time and can provide the business know-how and expertise in finding good deals and negotiating good deals, and then engaging with the companies after the investment. Groups are a great resource. When that company you're invested in needs a little assistance, you can bring it to the group and say, hey, is there anybody here who knows anything to help the entrepreneur move forward and meet some of these growth milestones that they're experiencing? You're dividing the work, which eases the pain. To me, joining a group is a no-brainer. And there are a lot of groups in the state of Michigan for you to participate in. The Ann Arbor Angels, the Archangels are new in Sterling Heights. Bell, Michigan is an all-women's angel group, primarily angel women's group, focused on investing in women entrepreneurs. There are the group we run, the Michigan Angel Fund, is a large group. You can join any of these groups at any time except the Michigan Angel Fund. And per their model, it has to be in a fundraising period because our model is to be in the group, you have to invest in the fund, which is a sidecar to your direct investment. And therefore, you can only join the group when that window is open, which coincidentally, the window is currently open. So if you want to explore joining the Michigan Angel Fund, now would be the time to do that. But with these others, you can join anytime. So here's the key, what you're trying to achieve in your due diligence process. First of all, risk assessment. Are you building a sandcastle or are you building the Parthenon? Something that's going to last centuries. It's got to be comprehensive and flexible, documented, and time efficient. You don't want to drag out the entrepreneur trying to raise this capital over months. They're trying to build a business here. So you want to be as quick as possible. And here are deal killers you should probably have, in the back of your mind, and entrepreneurs pay attention to these. First of all, are the terms unreasonable? What's that valuation like? If you have a pre-revenue company, don't come in and ask for $10 million valuation. Let's be realistic here. And, I always just say, does it pass the smell test? And if it doesn't pass, move on. You've got other deals you can look at. Entrepreneurs, you need to be thinking that way too. Is there excessive debt or current liabilities? You don't necessarily want your investment, new dollars, going to pay old debt, old bills, pay off other people. That's not the purpose of your investment. Is there any deception at all in anything you're finding in your diligence? If there is, bang, close the door quick. Harmful pre-existing agreements. Read those agreements. Is there a partnership agreement? Is there an agreement with a vendor? Is there an agreement with a customer? That take a look at those and see if there's anything that is harmful in your opinion to the company, stop right there if you think so. Disruptive management team or shareholder issues. One thing we do with our uh, diligence process is we like to talk to board members. We like to talk to other investors. We like to talk to other members of the management team, making sure that everybody's in alignment. Alignment's very, very important. If you sense that the management team is not in alignment, or your board and the CEO may not be in alignment, then maybe this isn't a deal you want to keep pursuing. Inappropriate use of proceeds, obviously, that's a red flag. And inadequate IP. Not everybody needs a patent. So that in and of itself isn't a deal breaker, deal killer, but you certainly want to make sure that the IP is in fact protected. And that the ownership of that IP is very clear. Are they licensing the IP, maybe from a university? That's perfectly fine. Read the terms of that license agreement. Could be from a corporation. Just make sure everything's in order. And if they are getting patents, determine whether or not you think they may be infringing and whether or not they're going to need many patents, not just one. So anyway, those are all deal killers. If you get a red or yellow flag with any of these, just end the discussion. Thank you very much, Mr. or Mrs. Entrepreneur, for the opportunity, but we're going to pass. And tell them sooner than later. So key diligence issues, some of which we just covered, the management team, board of directors, advisors, et cetera. But the opportunity is at large. Marketing, sales, competition. Take a look at all those things. Finance and capital, what's the life cycle? What's the expectation that you're going to, in terms of time, how long is it going to take you or the company to get profitable, cash flow positive if necessary, to raise the next round of capital? How much are they really going to need and over what period? Does the technology work? I mean, that may sound pretty basic, but confirm it, kick the tires. And is it a minimal viable product, or is the product actually out there being used and being paid for? And then, of course, make sure all the legal work is in place. And this is where the lead investor has a lawyer representing the investors and making sure that all that legal work is properly done and prepared and filed, et cetera. Due diligence process, obviously you do a management presentation. They give you the pitch. You create a due diligence plan to cover all those things we've already talked about. Site visits, in today's environment, we're doing a lot of this online, but to the extent you can actually show up and may feel you need to show up and actually look at the place of business, where the engineers are actually working and that they are actually working. You want to talk to customers. That can be obviously done over the phone or via Zoom, and talk to clients. You want references, want product and market analysis. If you can get that from a lot of various sources, some you'll have to pay for, some you can get for free and dig in yourself. Do a financial analysis. It's amazing how many times we look at a company spreadsheet and not all the cells tie together. And, they may show one projection on this page and then there's a different projection on the other page. Dig into the financials. And again, when you go into a group, there are people in your group that love this, that will dig into the financials. Other people will dig into the technology. Other people will dig into the IP and the marketing and sales aspect. So again, a benefit of the group. And then of course the deal terms, and then people in the group that have negotiated deals for years and know all the basic terms, et cetera, and what to ask for in terms of investor rights. So let's talk about terms. In the state of Michigan, we found last year, 2020, that note structures were becoming the norm. They exceeded stock. So 61% of the investments made in 2020 were actually done in the form of convertible debt. only 40% done as preferred shares. So what does that mean? Well, I'm going to talk about a term sheet. If it's a convertible note, it's a loan, and that's not equity. And let me just go back there. In terms of a note, what you have, usually you get interest, but it's accrued. Interest is never paid in cash. It's never paid out. Even when the note converts to equity, that accrued interest goes to the core capital that you've invested in and gets converted to shares. There's usually a discount in convertible notes, but you're a note holder. And so if the company sells or things happen, they pay the note holder before any of the equity holders get paid. That's one of the advantages of holding the note, of having a note. But at the end of the day, you really want that converted to equity. And so when the entrepreneur is raising a round of a seed round or an A round, which is what they're termed, that is equity. And that's the round when those notes are all going to convert in. So the term sheet is basically an outline. A term sheet can be 2 pages. I've seen it 7 pages, somewhere in there, depending on how detailed you want to be, but it's really an outline. It is not a contract. It is not, you could consider it, I guess, a letter of intent, but it's not binding. It's a list of the terms and conditions necessary to close the deal. It's unique to that particular deal. So there'd be nuances in a term sheet with every company. Keep it simple, and particularly in that seed stage, because there's going to probably be an A round, and you don't want anything in your terms in the seed round that is going to cause a new investor for the A round to pause, to balk, to say, no, we're not going to accept the terms of those seed investors. So keep it simple. It can be. It doesn't have to be complicated. May or may not be negotiable, the term sheet itself. And it's almost always non-binding. But it's a guideline for moving forward and then turning it over to the attorneys at this point. Once the term sheet's signed by both parties, lawyers work on the details. In structuring the deal, is the company an LLC or a C Corp? Where are they incorporated? Usually it's Delaware, but doesn't have to be. Financial terms, that's, valuation obviously is important to everybody, the investor as well as the entrepreneur. But you want to make sure you've also got in your terms the liquidation rights, redemption rights, preemptive rights. That's for angel investing 201, not angel investing 101. Investor shareholder rights, you want governance, make sure there's a board. What kind of voting obligations does the company have to require the shareholders to vote on something? Registration rights, anti-dilution, employee contracts, communications, high level, those are all in the term sheet. And confidentiality, of course, is very important. And who drafts the definitive documents. And you really want, in most cases, you really do want the investor's attorney to draft the documents. So post-investment engagement, this is very important to a lot of angels, but not all. In fact, not most. But to many angel investors, they want to know what the board makeup is, and this needs to be clarified in the term sheet. Shared governance, using the term sheet to say, are you going to have a 3-person board? Are you going to have a 5-person board? What's the makeup of that? 2 2-in-1's the norm. 2 of the founders, 2 of the investors, and then an independent person on the board. A lot of entrepreneurs aren't necessarily interested in being on the board, but they want to be considered, they want to be an advisor if possible, usually a short-term relationship. This is understanding the difference between an advisor and a mentor. An advisor often will get a little bit of equity for the advice they give. They can provide introductions to potential partners or customers or even future employees, help fill out the management team, may or may not be an investor, but could be in your group. As a mentor, though, that's usually a longer term relationship, and that's much more personal. This is where a person gets to know the founder CEO extremely well. They may even meet on a weekly basis. They call each other all the time. And this is a person who's giving that CEO their experience and advice. and it's a two-way relationship. So that's a big difference between an advisor and a mentor. And as an investor, do you want to be a director or not? Like I said, this is true of many angels, but not most. Duties of an investor. Now, again, entrepreneurs, listen up. And this is important for entrepreneur or for new angel investors to understand if you want to be on the board. Being on the board of a startup company is not anything like being on the board of a Fortune 500 company. You have a lot of the same responsibilities. So there is liability that's associated with you being a director. But here are the key things in terms of your responsibility as a board member of a startup. Number one, never, never, never run out of cash. Never let that company run out of cash. And when you start running dry, you've got to start asking the question, are we going to wind down, and make sure you've got enough cash to pay the wind down costs. Never run out of cash. That's board responsibility number one. Insist on regular communication with shareholders. Boy, this is my pet peeve. Too many entrepreneurs do not satisfactorily communicate with their shareholders. And some don't even do a great job communicating with their board. This I've got as the second bullet, but it's really number 3 bullet. But communication is so important, particularly when things go bad, because the last thing your investors want to know is, oh my goodness, I need more money. And here's why, here's all the bad things that I didn't tell you about that I should have. So communicate. I want to know the bad when it happens. Don't tell me later. I know bad things are going to happen. That's life. I ran a business. I ran a company. I know that you have issues once in a while and run into problems. Tell me about it. Don't hold it back. The third bullet here really should be the second. And the board's responsibility is to mentor to a degree, but you're representing shareholders, not just the CEO. Review all documents, review the progress on a regular basis of the company, and know when it is time to remove and replace the CEO. I don't know what the percentage is, but an awful lot of founder CEOs, when they start up their company, they're not the CEO when the company exits. And that's not a bad thing. So if you're a founder CEO, recognize that, sometimes the company will outgrow your capabilities. You can stay with the company, don't get me wrong. You're not being terminated. You're not losing your rights. You can stay on the board. You can become the chief technical officer. You can be the chief operating officer. You retain your equity. And but maybe the company needs a new CEO. And oftentimes that is in fact the case. And the board needs to recognize when that time is approaching, have that hard conversation with the founder CEO and manage that process. And then of course, the board is very involved with selling of the business when the time comes.